Good morning, everybody, and welcome to the Meet the Directors question and answer session for Surface Transforms PLC, hosted by our good friend Hardman Co.
Hello and welcome to Surface Transforms AGM presentation. My name's Kevin Johnson. I'm the CEO of Surface Transforms. Alongside me today, I've got Michael Cunningham. He's the CFO of Surface Transforms. And between us, we'll give you an update on the company and hopefully give you some interesting information about what we've been doing over the next 20, 30 minutes. Okay, what I thought I'd do, as always, is start with a very, very brief introduction about what we do and where it fits in the automotive market. We make carbon ceramic brakes. So if I start from the beginning, brakes are the bits that fit inside the wheel of a car. There are 4 wheels in the car, so there are 4 brakes, and they are used to slow and stop the car in a controlled fashion. And you do that controlling of the brakes by pressing a pedal inside the car with your foot. Now, the brake inside that wheel, if you look at that close up inside the wheel, there are a number of components installed on the car. And this is to give you that feature of braking, which is safety critical. If I break that foundation brake system down inside the wheel, basically it's made up of 3 components: a brake disc, a caliper, the red thing in the middle there, and brake pads. And the brake pads slot inside the red caliper. You can see some pistons inside there. Those pistons, when you press your foot, squeeze the pads onto the disc face, and it's the friction between the disc face and the pad that slows the car down. And from our business point of view, it's the brake disc we're interested in. And every car in the world has this kind of braking system on, but virtually all of them are equipped with iron brakes. And we are interested in swapping out those iron brakes for ceramic brakes. And there's a good reason to do so. If I talk about those compelling drivers for the growth of carbon ceramic brakes over iron, I'd probably start with the technology. And here we've seen over the last sort of 10, 20, 30 years, cars have been getting bigger, faster and heavier. And that means they're generating a lot more energy. And it's the job of the brakes to take that energy and then control the car. Now, iron brakes are reaching the limits of their capabilities. So by that, I mean that if you dump too much energy into an iron brake, you start to lose the brake pedal and lose friction, and the car's efficiency to brake reduces. You don't see that with ceramics. They work whatever the speed, weight of car is, and gives you the same functionality consistently throughout performance. So that's one crucial and big advantage. The other key advantage, if you like, is there's a massive weight saving between iron brakes and ceramics. We talk about swapping out all 4 corners of the car. You can save about 25 kilos, but this is unsprung mass. So that picture I showed you earlier about all these bits hanging off the chassis inside the wheel, if you can take weight out from there, you can start to strip out weight from other components within the car. And we talk about getting a weight saving up to 100 kilos per car. Now that is quite significant. So that for a 2-ton car is about a 5% weight saving. So you can imagine for weight saving programs, which all car manufacturers are doing, being able to take 5% out with just one technology is highly attractive. And the final point here is probably more relevant to electric cars than combustion engine cars. But we talk about ceramic brakes being non-corrosive. And that becomes important because an iron brake relies on the fact that it's being used all the time. And so that the corrosion buildup on an iron brake doesn't start to get too great, so that it can cause what's called galvanic corrosion between the pad and the disc. And if that happens, you can get a brake seizure and the brakes won't work. Obviously, if you can eliminate corrosion, that's great with ceramics. And for electric cars, where you're not using the brake as often, there's a much higher risk of getting that seizure of brake through galvanic corrosion. So with ceramics, you can eliminate that problem. Now, following on with that, with the advantages of light weighting on cars for the environment, we can reduce the CO2 emissions by taking out that weight. Obviously important for combustion engine cars. Equally important, that light weighting is for electric cars for range. And another feature of ceramic brakes is that they significantly reduce the brake pad wear. Now, brake pad wear is, if you like, the next major pollutant from cars after engines. The pad particulate dust generated through braking ends up in the air and waterways. And if you swap out the brakes to ceramics, you can reduce that wear by about 50% and hence reduce the pollution by about 50% as well. The next key feature is it lasts the lifetime of the car under normal driving conditions. So rather than having to replace iron rotors typically 4 or 5 times through the lifetime of the car, you have one set for life. And that leads us on to then talking about the cost of ceramics. Although they're more expensive up front, we talk about the total cost of ownership being reduced because you're not having to make future investments in replacement parts and then paying for the labor, and also those increased pad wear requires frequent pad changes rather than getting that with ceramics. So there's a compelling case economically for swapping to ceramics from iron over the lifetime. Again, coming back to the lightweight features, the quality of the cars improve with handling. You've got this gyroscopic effect of all this weight hanging off the chassis, having to be pulled around corners. If you can reduce that weight, improve the handling. And again, for bumps in the road and comfort and refinement, taking all that weight outside the wheel helps the refinement of the car. The final piece, if you like, for ceramic brakes is the aesthetics. The brake disc is usually has a mirror-like finish, so it's highly desirable and it's on show. So people like the thing to look good. Again, it doesn't corrode, so it doesn't look unsightly. And again, a feature of the pad dust is that the car alloy wheels will stay cleaner for longer because they don't have that debris building up around them from the braking activity. And finally, a feature of this market is if you look around the world for competition, this has been very much a monopolistic supply by our competitor, Brembo SGL Carbon. Their revenue is about 160 million. And for this market to function properly, particularly for automotive industry standards, it's virtually unheard of to have a monopolistic supplier. And so there's a big driver for an alternative supply, and that's where we find ourselves as the most credible of those alternatives out there. And that has seen, as I say, a lot of the car manufacturers adopt ceramic brakes. I've got a few of them there. That's not an exhaustive list, but you can start to see that this has been well adopted across the premium luxury end and performance end of the market. Now, onto our activities and onto our OEM customers that we work with. We're engaged with an increasing number of OEM customers. I've put a table here, which I've shown before, listing the companies we're actively working with. The ones in bold are the ones we've either had contracts with and completed or are current contracts. And we use this coding of 1 through to 9 currently, with new OEMs coming through as well, to describe them. Because it's not because this is, if you like, a sensitive information from the market point of view. It's commercially sensitive. So our customers don't want their competitors knowing what they're doing. So we have to keep their names out of the public domain. Now, in terms of an update with those customers, we have one of OEM 6, which is a British performance car manufacturer. We have a contract with them worth about 1.5 million. It's a standard fit. We're a tier 2, meaning we supply into a brake system supplier who supplies to the OEM. And that car is due for launch in the second half of this year. With OEM 5, who's a German car manufacturer, we have a contract with them worth circa 10 million. There we're a tier 1. And for that contract, it's an option on the front axle only. And that's due for launch in 2022. And we're currently doing the engineering for the system integration phase prior to launch. For OEM 7, which is a Swedish car manufacturer, we have 2 contracts, one worth 5 and one worth 1, so a total of 6 million for standard fit. On this one, we're the tier 1 supplier. We're also the sole source supplier for ceramics for this customer. And those launches are progressing with, again, the engineering for the system taking place. One for launch for this year and one launch for next year. And then we have OEM 8. That's a global car manufacturer. Contract value worth 27.5 million as a standard fit. I'll describe OEM 8 and OEM 9 in a moment as disruptor OEMs. By that, they are typically looking to accelerate their launch times from what can be up to 3 years to less than 2. In this case, this was about 18 months. We are a tier 1 supplier, sole sourced again, and that contract is due to launch in this year. And again, we are doing the launch engineering is well underway and occupying a lot of our time within the company. The final update from a customer perspective is OEM 9. That's still in pre-contract, and we don't normally talk about stuff we haven't won yet. But because they're a disruptive OEM, again, they have accelerated timelines. And for us to ensure that we are able to supply with the capacity needed, we've had to start looking at OEM's requirements. But we are expecting them to complete their sourcing and selection of supplier during this year. Moving on to the customer values and our customer strategy. Our strategy is to be if you like, a world-class profitable manufacturer and engineering company for carbon ceramic brakes. And to do that, we break it down into sort of 6 key components. First being the product. As I mentioned earlier, we have a competitor in this marketplace who's the monopolistic supplier. But ceramic brakes are not necessarily the same in terms of their performance. They are made up of the same materials, carbon and silicon, but it's how you put them together that counts. And our processes generate a superior technology to our competitors in terms of how they dissipate heat. Brakes are all about converting all of that kinetic motion energy into heat. So it's a very important advantage to have good heat management. And that can translate then into additional weight savings and a longer life brake. We're also, although we use different processes, we're effectively at a different scale than our competitor currently. We are cost competitive and price competitive. So we are actively winning contracts, as you've seen, up against our competitor by being price competitive. Capacity is a major part of our planning and our activities within the business. We have installed 20 million of capacity revenue to date, and I'll come on to this a little bit later. And we completed a fundraising activity earlier on this year, and we've started the project to install capacity to bring that up to 35 million of revenue capacity for the future. And that's in the context of our site, which is expandable up to 75 million. Quality, as always, is very important, and we're certified to the standards for quality within the industry, which is called IATF 16949. And coupled with that, we are also certified to the environmental standards 14001 and the health and safety standards 45001. Moving on to ESG. We have a very, as you probably gathered, environmental product. It helps the industry, the automotive industry, achieve some of those environmental benefits. And we also see opportunities from an internal perspective of reducing our carbon footprint for the future. And we operate in an area which is one of the most disadvantaged regions in the country, up in Liverpool. And we're very proud of the fact that we are generating new jobs and currently doing a lot of recruitment. So as part of our social responsibility. And further to that, in terms of governance, we do operate to the QCA code of corporate governance. So that's where the business, if you like, positions itself. And over on the right-hand side here, that's all in the context of what we see as a £2 billion potential market. And as you can see from the bar chart below that, last year's revenue were 2 million. This year, I think our guidance out there is revenues will be just shy of 7 million, and principally from those customer activities with the contracts we have that are launching this year, and that'll bring profitability. Next year with contracts, the revenues will grow to 13 million just by having a full year effect, and we'll see ourselves move into profitability. And that's in the context that if you look at our customer demand going out to 23, our customers are telling me that there's demand for circa 30 million per annum. And our pipeline in terms of prospective contracts going through is in excess of 75 million going out to 24 and beyond. Now, I'd like to talk just a little bit more about capacity because although I've just mentioned all the revenue models we use to plan our revenues, our capacities should be planned on what our customers are telling us. And those generally are higher than our revenue planning models. And as you can see, when we look at current contracts plus carryover models, and carryover means we're going to take the existing product that we use on one car platform and save the engineering costs, time, and carry that over onto a future platform. And I've also included OEM 9 because of the accelerated timeline to launch for that one. You can see our revenues in terms of capacity requirements are just shy of 10 million for 21, so circa 7 to 8. They could potentially rise to 20 million in 22, to above 25 in 23 with carryover models. and that subsequently rises up to just shy of 35 million for 2024. And you can see that with those contracts in 21, contracts in 22 with a new OEM, and those carryover models for 23 and 24. And that's what led us earlier on in the year to say that we needed to build more capacity to support those customer activities and customer contracts. And that's why we've gone ahead and started the project to increase our capacity to circa 35 million per year to support those customers. Now, there's an extra bit to this story that if I look at then a little bit further out beyond 23, if you like, through to 24, 25 and beyond, you'll realize that we're working on a significant number of other OEM programs, and these are all active programs where we're working and testing with customers. And you'll see that there's a significant increase in demand going out 24 onwards. And that's useful in terms of de-risking our approach in terms of the capacity investment we're making now, so that if something gets delayed, we've got other things that can take that capacity if needed. But also, it's our prospective contract pipeline, and that fits very well with our footprint and our scalable approach to capacity to circa 75 million over the next 5 years. And then just to remind everyone how that works in terms of our factory, we've got floor space of 55,000 square feet facility. The majority of that is for manufacturing. And as you can see with that plan view on the bottom left there, we split the site into manufacturing cells. We have an SVP cell. That's a small volume production cell. That does all of our small volume near OEM customers, retrofit business, and prototyping for OEM projects. We've installed our OEM cell 1 next door to that. And as I say, that's coming on stream for those contracts this year. And we made the fundraising activities earlier on so that we can invest in OEM cell 2. And that will go alongside OEM cell 1. And then how we scale that on the right there with that bar chart, we had 20 million installed with OEM cell 1 and SVP. We'll have the OEM cell 2 installed at the back end of 22. So that's where we talk about having capacity revenue 35 million through 22, 23. And we can then talk about how we get to 75 million as a footprint by adding in OEM cells 3, 4, and 5, which are replicas of 1 and 2. So just moving on to our operational and capacity updates for you. A little brief note on COVID-19. We're very pleased to say that we've maintained all operations throughout the pandemic, and we've remained open with all functions as best we can. We're actually quite pleased with how we've done during the pandemic with operational efficiency and output increasing. Now, that doesn't mean it's not there. We work in a COVID-safe environment, and we will continue to do so. But we hope things will improve as the year goes on. In terms of Brexit, similarly, we've seen no material impact. Although I will say there were some logistical delays experienced on some of our shipments in the first quarter, but those have all now been resolved. And we were very pleased to announce that we've completed our certification to the health and safety standard 45001, and that was implemented through that period of the pandemic, which presented some unique challenges, but we were very pleased to get it to complete it. And that's really formed part of our goals as part of and complements our ESG objectives for the future. And we believe there's more to come there as well. And part of our expansion and growth this year also includes recruitment. And we've been progressing with our recruitment activities throughout this year, and they are progressing well, and progressing well across all functions. We aren't seeing any difficulties in finding good people, albeit we are taking our time to do so because we'd rather build the right team and protect our culture, because we're very proud of our culture within the business as well. And the last point here, we continue to do all our product engineering across all customer activities, and I'm pleased to say that's going well. I always try and pick up here and anticipate a question for OEM 3. That includes this unique environmental test for OEM 3 that is progressing and progressing as planned from our perspective. And we are in discussions with the customer about how to take that forward. The last part of this slide is all about the capacity. and a brief comment on OEM Cell 1's capacity. As I mentioned earlier, I think it comes into series production this year with the launch with OEM 8 program. And with that launch, it will achieve our cost reduction plan to half the unit cost over the last 5 years. And that's come together quite well. We don't see that as the end, I might say. We believe there's more to come on our cost reduction activities, as there always is for an automotive company. The final point on this slide is really about starting the capacity expansion for OEM Cell 2. We started, if you like, the sourcing and the allocation of contracts for the equipment for that, and that's happening through the spring. And for the long lead times, will be done for the summer for things like furnaces. And we talk about 18 months to bring all that together, and that's principally with the critical path being some of the key big furnaces. So hence why we're trying to get those issued and done for the summer of this year to see them arrive 12 months from now and then be commissioned towards the second half of next year. A cell costs about 10 million, to remind everyone what we told everyone at the fundraising for the cost of this thing. And the return on that investment is about 15 months at full capacity. Now I think I'm going to hand over to Michael, and Michael will take you through some of the finances and some of our outlook.
Thank you, Kevin. Just starting off with a bit of a comparison of this year compared to 2019, and I'm comparing to the full year, even though we didn't report that as a full period. So the first thing I'd like to talk about, obviously, is our revenue, which has remained fairly much in line with 2019, despite obviously the COVID impacts, which delayed the OEM 6 program. And despite the fact that that 2019 full year did include the OEM 1 contract at the back end, so you can see the solid growth that's been there through our retrofit and near OEM sales during the year. So we're very pleased with how the year actually panned out from a revenue perspective. Going on to Ebitda, you can see again we're very much in line. That's been led predominantly because our costs were fairly static. We went into the year with quite a hefty headcount increase from the previous year, and in addition, that was led very much around the strengthening of our senior management team. That was offset a bit by the CGRS, the coronavirus job retention scheme. We received just under $250,000 for that, and so our EBITDA ended up being very in line with the 2019 figures. Profit before tax again remained fairly flat, and predominantly because our interest and depreciation, there's been very little change in that. That'll change in the coming year with the introduction of OEM Cell 1, and as we start depreciating the equipment in there. And then finally, our profit after tax. This is where you do see a difference, but that is predominantly driven by the change in tax accounting policy that we had during 2019. If you remember, we changed from cash accounting to accruals on our tax credit, which meant that in 2019 we actually recognised 2 periods worth, and that obviously led us to have a reduced loss after tax. So looking at finances going forward, our expectation is that our profitability during 2021 will go positive on a monthly basis. With the OEM 8 contract, just when that launches, so profitability on a monthly basis. We also expect to have operational free cash flow excluding capital investment, and that will fund all of our capital investment up through to 2023 alongside the fundraise that we did. So that's obviously a real positive for us as well. And our profitability, which occurs in 2022 from a full year perspective, will change our approach to funding opportunities, because we've got obviously, with being a profitable business with a bit of history around us and long-term contracts, our opportunities to approach different funding streams will be there. And then finally, as Kevin's alluded to, in 2023, we hit that sort of £35 million turnover, and we expect our net profitability to be somewhere in the range of that 20 to 25% level. So that's really quite healthy. One area that we've been looking at recently is tax, which we believe will remain a quite significant issue for us in the medium term. We expect our R&D levels to remain at current sorts of levels as we try to refine our processes and efficiencies. So we expect the R&D tax credit to remain at its current level going forward. The budget announcement of the super deduction tax for capital expenditure dovetails really nicely with our own planning for CapEx. So you'll see that most of our capital expenditure through to April 2023 will actually fall into that scheme, giving us 130% year one deduction to our tax. And as a result, we believe that we probably won't have to commence paying tax on profits until somewhere around 2025. So that we feel is a very positive message for the company, as we'll end up with a tax shield that will significantly cover our profitability. So I'll hand you back to Kevin to wrap up.
Thank you, Michael, for that. And let me just try and give you then a summary of what we've been talking about today. We just had Michael tell us about the trading, and that's in line with expectations. And then from a business overview perspective, we now have multi-year recurring OEM contracts in place. Contract values that we've announced during the last 2 years or so have a value of circa 43 million with 4 OEM customers. And that leads us to talk about growing revenues with good margins. And we can then talk about leading to profitability and a positive EBIT in the future, going through 21, 22 and beyond. And that's obviously in the backdrop for us and the perspective of having a project pipeline in excess of 75 million per year over and within the next 5 years. Now, you've heard me talk about how we do our business planning and use 2 scenarios, one being from a commercial risk point of view, dealing with how we deal with our revenues and how we deal with our additional profitability questions we have. And I think the guidance that's out there is for this year, just shy of 7 million, next year, just shy of 13. And all those are with contracted customers. But our customers tell us completely different numbers, if you like, for what their demands might be. So we need to follow those customer requirements to plan our manufacturing capacity and capabilities. Now, that led us earlier on in the year to complete that the fundraising to start building OEM Cell 2 and to allow us to start growing our capacity revenues from 20 million right up to 35 million as the next stage. And that really is to support current contracts, carryover models. As I mentioned, this is where you take the existing product and put it on the next model of car that the customer is working with to save the time and the costs of developing a new product for that. And with OEM 9, one of those disruptive OEMs. And it's what we've been doing as management of the business to ensure that we assess the risks in terms of timing and that capacity requirement to make sure that the time to build that OEM Cell 2 was this year. So it was available towards the end of next year. So that is a £10 million cell investment. As I mentioned, the return on that investment is about 15 months at full capacity. So it's very attractive. And as mentioned by Michael earlier, all of that investment is then covered by the super deduction tax that was introduced this year, which will be very beneficial to us going forward.
Right, so you have in front of you the board, and I'll introduce them in alphabetical order. We have Michael Cunningham, our Chief Financial Officer, Richard Gledhill, Non-Executive Director, Kevin Johnson, our Chief Executive Officer. We have the first of our new non-executive directors, Matthew Taylor. Matthew was also recently elected as Chairman of the Audit Committee and by implication Senior Independent Director. And the second of our new non-executive directors, Julie Woodhouse. So I'm going to get started by taking the first of the questions. We can now get on with the proper session. The first of the questions, which came in advance, I was actually directed to our new non-executive directors, and just to say a little bit about themselves, introduce themselves to the shareholders, because the shareholders know the rest of us, and say a little bit about yourselves and perhaps what you found interesting in Surface Transform. So, Julia, should we kick off with you?
Absolutely. Thank you, David. Good morning, everyone. As David said, I'm Julia Woodhouse, and recently have joined the board of Surface Transforms, and very proud to be part of the team there. I thought I'd just give you a very brief overview of my background, and then touch a little bit perhaps on what I feel I can bring in terms of adding value on your behalf to the board, and perhaps some thoughts, as David said, about the company. So my background, my executive background, is in automotive. I spent around 30 years, in fact over 30 years, working for Ford Motor Company, and also in that time had opportunity to work with many of the other OEMs, from GM to Volvo, Jaguar Land Rover, Fiat, etc., on many joint projects, but particularly had the opportunity to work with the global automotive supply base, because I held a number of purchasing global leadership roles for Ford. So that gave me the opportunity, as well as working on vehicle launches, to work with the suppliers, both large and small, in terms of bringing their products and technology to market. And of course, building strategic relationships between the suppliers and the OEMs. I had a very international executive career, as well as having teams globally reporting to me. I had the opportunity to do some overseas assignments. Ford asked me to go to the US in 2011 to help lead the growth of their global powertrain operations. And I stayed in the US for about 5 years, until 2016. And after that, I went to Germany, where I headed up the global chassis procurement activity for Ford, and co-led the chassis division with my engineering colleague. I probably spent about 10 years in total working in Germany during my executive career. And then following that, I've moved into my non-executive path, if you like, which started at the beginning of 2019, when I was fortunate to be invited to join the board of Outokumpu, which is a leading listed global stainless steel manufacturer. They employ around 10,000 people globally. And I'm a member of the board audit committee, and recently joined their ESG advisory council. And I also sit on the Standards and Regulations Board at the Royal Institute of Chartered Surveyors, which is a new board with an international focus. So in terms of joining Surface Transforms, it seemed like a great opportunity for me personally to join a growth company with a really interesting technology that they're offering to what is a fairly monopolistic situation in that particular area. And I met the team, of course, the leadership team and the board, and felt the culture of the company was an inspiring one. And I felt it was an area where I could add value, because clearly as a non-executive, you want to be able to add value on behalf of the shareholders and stakeholders. And on reflection and talking with David and Kevin, etc., I felt that I could bring my pretty extensive automotive experience, particularly around launch and organisation and scale up, to the team, combined with my listed board experience, to help with the governance as we grow the organisation. And so I think that that's where I felt that I could add value on your behalf to the board. And certainly my initial perceptions are very positive of the team, very hard-working team, very focused on the tough challenges ahead. They're always tough challenges in automotive, and I'm very much looking forward to being part of the board and representing your interests there. So delighted to be part of it, and thank you for the opportunity.
Thank you, Julia. Matthew, could you say a few words as well now, please?
Yes, thank you, David. Actually, very similar to Julia in many respects. Maybe a little bit about my background first. It's mainly industrial. I've spent most of my time in industrial businesses. I started on the commercial side of things, but moved into more general management roles really for the last 20 years or so. I also spent a long time in Ford Motor Company, 21 years. The last 6 of those at Land Rover. I was part of the team that bought Land Rover from BMW into Ford, and then ran the business as global managing director for 4 years. I moved from there mainly because they wanted me to go and work in Detroit, so I saw an option of not really wanting to do that at that point in time. So I moved to JCB, who were chasing me, and ran the JCB business for 4 years. For the Bamford family. And after that, I moved to a private equity-owned business called Edwards, which wanted to float and was undergoing a fairly significant transformation. They wanted me to lead them through that, and I took that business as CEO and floated it on the NASDAQ stock exchange in New York. And once it was bought out of the stock exchange by Atlas Copco, I moved from there into a Belgian company, which most people probably won't have heard of, called Beckart, which produces steel wire products, a very big supplier into the automotive industry. So I spent 7 years in the automotive supply chain again there, mainly into the tire part of the business, but also with other applications as well. So a lot of automotive background, nearly 30 years of automotive background within that trajectory, but really strong in both automotive supply chain and industrial activity as a whole, with a very strong global set of experiences and running operations around different parts of the world. When I left Beckart last year, I wanted to start looking at a few roles, a few NED roles. And I wanted to look at industrial businesses because that's where my background is very strong. I wanted to look at businesses with very strong potential for growth, businesses with strong leading technological solutions in their fields and the applications that they're going after, businesses that were ambitious to achieve the potential that they had, and with strong management teams, strong leadership and motivated people in their business. And on all of those criteria, I found exactly what I was looking for in Surface Transforms. It's a very exciting business, and you know, when I look at the potential that's there, and I look at the people that we have in the business, it really excites me. It excites me. It motivates me, and I think as a team, they're ready for the challenges that they face. The challenges are not insignificant, but you always feel that if you've got the right people there and the right focus on it, those challenges can be overcome. And the real potential that sits there in this business over the coming years with the changes that are going through the automotive industry is truly exciting. And so when I looked at this as an opportunity, I felt this was somewhere where, one, I would enjoy working, two, I could really add value with the experience that I have of my industrial background and my working around the world and in the automotive supply chain, and hopefully add value as a whole to the team. So that's what excited me about it. I'm delighted to be here. I'm delighted to be able to represent the investors on the board as well. And I look forward to working with everyone. It's an exciting opportunity. Thanks, David.
Thank you, Matthew. And I suppose on behalf of the board, I'd say how pleased we are to have Matthew and Julia on board. What are the biggest risks to Surface Transforms over the next few years?
Yeah, we've been asked this before, David, and the biggest risk by far is the implementation risk for our business plan and effectively building capacity to meet that demand that we see in front of us that is already contracted and is growing. And you know, that's really what the main activity of the business is around and focused on. We've built cell one, if you like, and then we're using the learning and the experience in cell one, and frankly the 10 to 15 years of experience of our product and processes to then add cell two at the capacity there, and then kick on to further grow the business in Knowsley. As we know, it can expand beyond that within the facility, right up to cell 3, 4, and 5. And the other part I would mention to cover that risk of implementation is, it's already been mentioned by Matthew and Julia, is the team and the experience and the skills of the team. And we continue to strengthen it as we go. And it's that team that de-risks that implementation challenge we face over the next 3 to 5 years.
Yeah, I think we might add, it doesn't affect the grand scheme of things, but customers can be notorious on their start of production dates. We've had spades on Valkyrie. And so I think, actually, I remember being asked this question at the fundraise, and what's the risk? And I said execution, execution, execution. And but I would add start of production. There's another question on risk, which I'm going to ask Michael to deal with, and there's in fact it's the two questions really, same question differently. Are you at risk from major changes in commodity prices, and are you at risk from exchange rate fluctuations? Can you deal with them as separate subjects, please?
Yeah, of course, David. So if I deal with commodities first, then the truth is, yes, we are exposed to commodities. We use carbon fiber and gas into our processes. So there is an element of risk on that. We're doing as much as we can with our suppliers to minimize that risk. But I think Kevin and I would be most unhappy if we weren't able to make the savings in our processes going forward to mitigate that. So whilst there may be an exposure to commodity prices, we believe that there's an awful lot that we can do within our internal processes that will mitigate that by reducing our reliance. And we've got some very interesting projects on the go at the moment that we think will increase our productivity and make things a lot better internally, actually. So we're trying to manage those risks ourselves rather than rely on the market to save those. As far as currency goes, our exposure to our sales is very minimal as it happens. We've been negotiating most of our contracts in sterling, which obviously saves us any exchange risk on our sales side. Some of our commodities we are purchasing in euros, so there is a bit of an exposure in the short term for that. But once, and I point to OEM 5 particularly, once that comes on stream, we have a natural hedge there against our commodity prices actually. So exchange will be not particularly large as far as exposure goes. And as I say, whilst we've negotiated our most recent win with OEM 8 in sterling, we're seeing that continue with other OEMs as well, as they look to hedge their own positions actually against sterling, so which works to our favour.
Thanks, Michael. I have to say I've been quite pleasantly surprised by the success we've had in negotiating overseas contracts in sterling.
Yeah, it's been
well done team on that.
Helpful.
Kevin, there's a question on the timetable for OEM Cell 2. You may have covered this in the presentation because this question came in advance, but can you deal with the question, what is the expected timetable for installation of OEM Cell 2?
Yeah, I mean, I suppose the first message there's no change from what I talked about, I think, in March, where we were embarking on the sourcing. That sourcing for the critical items which are on the critical path for the project of expanding capacity on the furnaces, those are going to plan, and it really means the implementation of delivery of those furnaces, and then all the ancillaries will come on stream in the second half of next year as capacity available for production. But it'll take us from now till next year to fabricate all of those things off-site with the supply chain, then bring them in-house, install them, commission them, bring them up to the right work rates, and sign them off, basically. But it's the second half.
We've been pretty consistent in saying 18 months, haven't we?
Correct.
We said it during the fundraise, we said it before, and one of the reasons for that is because it takes 18 months.
It does.
There've been a number of director and PDMR share buys and switching shares into ISA and SIPs. Is there any significance in this? And I'm going to ask Richard Gledhill to take it because his was the biggest. So Richard, over to you.
Yeah, thanks, David. Well, I think the question probably has two sides to it to some extent, and probably deserves two answers, part answers. First is fairly easy, I think. Of the management and directors who have made share purchases, and as David says, I'm certainly one of those, and transfers into SIPs and ISAs, I think it's fairly safe to say it just reflects a strong confidence that they have in Surface Transform's ability to deliver on the game plan that's in place. And I think, simply put, we all believe there are better days ahead of us, even better days. And probably lastly, on the SIPs and the ISA fronts, after all, no one likes paying taxes. If if it can be avoided. So I think that's fairly basic on that front. The second part is slightly more nuanced, I think, in so much as the inference is, what do we know? And of course, the answer to that is, we know nothing of significance that's not in the public domain. I think that really the takeaway here is one of overall confidence in the direction of the company, that we are very positive in where we are, how we're going to achieve it, and we look forward to the future. I think that's probably it in a nutshell.
Can the non-executive directors talk about the key challenges they see? I think you covered it a bit before, Matthew, but what do you see as the key challenges? You kick us off.
I think it's already been touched on as the key challenge, as you said, execution. So the implementation of the current plan. And I think it's really the focus of the next sort of 12 to 18 months has to be primarily on that ability to execute, ability to meet our customers' requirements in a way that continues to build our reputation, standing, and the impact of our solutions into the industry. So I think the short, and I would call that period of 12 to 18 months a short-term period. I think the short term, the execution and the ability to implement and having the right people to be able to implement is absolutely the right challenge, and the team are extremely well focused on that. I think the challenge in the slightly longer term is to really look at the overall scale of opportunity that's ahead of us as a business, and to see how we can quantify that and how we can prepare ourselves to take advantage of that potential. Because where we sit today is at a very small point. We know we've got a huge growth curve in front of us with sort of existing customers and on the business that we're talking to people about already. But the broader application of the technology that we can put into vehicles in an industry which is moving further and further towards vehicles that require the sort of weight reduction and performance improvements that we can provide is huge. And so the opportunity for us to be at the forefront of driving that change and becoming a key supplier into the industry is where we need to focus our attention. So I see that as the biggest challenge. And in itself, that will then draw, I think, the next big challenge for us, which is competition. At the moment, the competition is extremely clear to us. It's either the existing technologies on the iron brake side or our key competitor on the carbon ceramic brakes. But the more interesting the opportunity becomes, the more you are likely to get challenged by other competitors as well, who just aren't there today, but may see it as an opportunity. And so that's, I would say, the third big challenge that we have to be ready for as we look to our future.
Julia, do you want to add to that?
Just a couple of things. I agree, of course, with all the points that Matthew made very well there. I think launches clearly are always challenging in the auto industry, because suppliers are always, however well they do themselves, they're always very heavily dependent, of course, on the OEMs. And having been on the other side of the fence, I know that the OEMs are not always the best in terms of providing the right information in terms of volumes and dates and things to suppliers. So that always remains a challenge, and we have to stay flexible and work closely with our customers around that. So a launch execution, clearly. I think there was a couple of questions coming in around people, and I think as we scale up the company, like any company, you know, we have a strong bench strength today, but we all are going to have to add to that bench strength and the capability of the team. So that's going to be a challenge and an opportunity as we move forward, both in terms of hiring the right people and indeed developing our own people as we get bigger. You know, more focus around training and development, which I think will be, you know, something that we'll be able to do as we grow and expand. Clearly around the subjects of ESG, environmental, social and governance, they're something that everyone is increasingly aware of and will be challenges and opportunities for all companies. And certainly I know the board and the executives at Surface Transforms take that very seriously and the responsibilities there. So that's going to be some challenges that we will need to further. So they're just a couple of points that I would add, I think, in addition to the comments that Matthew made.
Richard, do you have anything to add on that question?
I think it'd be very difficult to add to what my two colleagues have said there. It is a complete focus on execution in the short term. But Julia's point is well made about the ESG. I think the environmental side of the business is something which is important. It's be important to customers. It'll be important to investors. Yeah, I think that is increasingly going to come into the business as we go forward. In the short term, of course, we've made the point a dozen times. It is about execution.
Is recruitment of more of the right people a risk? How capable are Surface Transport of developing people within the organisation? And could you just flesh out the remark in the AGM presentation about wanting to protect the culture of the organisation? Just say a few words about the whole people.
Yeah, look, we are going through a big recruitment drive right now, and that's going very well actually. And most of those recruits are from the local area or the surrounding area to Knowsley, and that's pleasing as well from a ESG point of view and social point of view from the company's perspective. In terms of developing the skills within the business and the people within the business, that's something we've done for many years already. If I think about that in more detail, and we already have a culture of looking within for skills, and that's been through necessity rather than choice. One of the features of this business is most of the skills and knowledge is unique. We can't go outside and simply tap into the world and ask somebody how to do something, because we're at the forefront of figuring that out and developing it ourselves. So our culture is already one of get on with it, can do, let's figure it out, and how hard can it be? And that's part of the development of all the people within the organization, that they're expected to develop their skills as part of the business. So what I would say is there are a couple of areas, more niche technical areas that we are recruiting for, that perhaps have led to us having to look further afield than the local area. And those are very specific engineering skills that we've been looking for, principally on the brake system application areas, rather than any of the technology for ceramic discs. But that's something we've been able to address by looking a bit further.
I'm going to take a question from Peter Duff here, which is, I'm going to ask you to take this one as well, Kevin. Is, what are the implications of the switch towards electric cars for Surface Transforms?
Well, the simple answer to that is huge. Electric vehicles, we've said it now for perhaps the last couple of years, actually, that electric vehicles are good news for Surface Transforms, that they're good news for carbon ceramic brakes. So it's good news for both ourselves and our competitors for carbon ceramic brakes. It's part of the reason why we see a big opportunity in front of us. Our technology, our products dovetail very well with electric vehicles, and I know I've said it in many presentations, but not least because of their lightweight nature, so that they can extend range. They don't wear out, so you don't have to replace your brake discs like you do on an iron rotor. They're environmentally friendly, which again, for the greener environmental choice in electric vehicles, very important in terms of they don't generate as much pad dust and therefore pad dust pollution, which is becoming more and more of an issue for the industry and for the world, as the CO2 emissions from cars will reduce with the elimination of combustion engines. So in a nutshell, electric vehicles are very good news, and that's being seen with the contracts we're winning. I think when we last looked at this, probably half of our programs we were working on or active with or already won were related to either hybrid or fully electric vehicles, and we see that trend continuing in the future.
Yeah, it's actually quite difficult at the moment to find a vehicle manufacturer that isn't working on electric cars. So to the extent that we're working with virtually everybody, we're working with virtually everybody on electric cars. There's a question here from Richard Emsley asking about the restraints, the guidance on the size, the opportunities that have the pipeline have been announced.
Putting it simply, we see beyond our current contracts, a new OEM and carryover, which should take us to full capacity of OEM Cell 2. We can see a pipeline of opportunity that will fill Knowsley. And as we said, Knowsley's capacity, we think, is around 75 million per annum. So we are currently working on a pipeline, which is in a lot of cases quite advanced. That'll take us to filling the factory in Knowsley at 75 million per year.
Yeah, I'd also add that the brokers, the analysts that cover us, including Hardman, have their notes on their notes are available on our website, and that the issue about what the future looks like is in there. And a question from Mark Dean about what's the timeline to conclude negotiations with the new OEMs.
Okay, well, that is always a difficult one to answer, and we used to try and answer that question with detail, and we've learned to not answer that question in detail anymore, because it's not in our control when sourcing decisions are made by OEMs, and invariably they will give you a date, and that date can move. But to give you some guidance on what we see as future contracts and news flow, I think we'd be disappointed if we weren't talking about new contracts during this year. So we don't comment on it specific OEM contracts, but to give you that guidance, we would be disappointed if we didn't have something new to talk about.
I was asked by one of the institutions why we won't give timetables, and I said because I don't think the customers know themselves. Can you say what are the challenges you face in generating new orders from existing? I mean, what are the USPs? What are the difficulties? You know, what is it we battle about, I suppose, is the question when we're winning orders, Kevin?
Yeah, well, for any automotive business, it starts quite simple at the top level. It's all about price, product, capacity, security of supply, and quality, and those things. And increasingly, ESG has become part of that. So those are the 6 tenets, if you like, that are always assessed by the OEMs. The process is, and linking back to the last question, the process is quite arduous and time-consuming. A lot of time and effort, and understandably so by the OEMs, is spent on making their decisions for sourcing of contracts for future cars. And the reason why they spend all that time up front and investment up front is simply because once that decision has been made, everyone's locked in. You know, they can't afford to be let down by their supply chain once that car goes into serious supply and goes through launch. So to mitigate that risk, a lot of effort and a lot of detail. I mean, the detail required by all of our customers is immense. And so a huge amount of activity goes in from both us and the customer to ensure that we've met all of their customer requirements in detail. And it can take months to achieve all of that, with a full conversation across all parts of the organization, covering both production, capacity, logistics, engineering for design, engineering for process, and quality, not least of all. So it's a very, very detailed and expensive process to complete with an OEM.
And within that there's a subset of that. For a question again from Julian, how price sensitive are your customers? To what extent are you subject to price pressure from customers and prospective customers?
I think you've told me anecdotes, and I know Matthew and Julia are both forward related. Price is always a question that is fought over, and should be expected to be so. What I would say about price sensitivity, though, beyond that initial, well, pricing is important, is that the customer wants to ensure that they get not just the best price. They want to ensure they get the right product, the right supply, the right quality. So there is price sensitivity, but within that price sensitivity, I've been pleasantly surprised with the pricing we've achieved with our current contracts, because they recognize the value proposition, not just from a pricing point of view, but from a whole company perspective and a supply point of view.
I don't know if you want to add to anything to that, Julia, from your, because it's normally people like you we're arguing with.
Yes, absolutely. And I think clearly the OEMs are price sensitive, some more than others, it would be fair to say. But I think increasingly they have been looking at what I'd call the sort of total value equation, and making sure that they're not just buying, even, you know, I can remember when I was leading sourcing, we were not always buying the cheapest option, if you like, on the surface from our available suppliers, but making sure, as Kevin said, that we understood all the different aspects and strategically we're making the right decisions. So I can certainly sympathise with your comments, Kevin, that it's a very detailed process because it's a big decision. And I think they want to understand, you know, the cost of quality, the cost of performance, what the perception of the customers, etc. So I think increasingly they do look at a total package, although I think in the automotive industry, there'll always be an element, of course, of price sensitivity, but that will vary by OEM, but they will look at other factors, you know, the weight and the, say, quality, etc. And increasingly that's a total package approach, which is why they want so much data and want to make the right decision.
Do you see the relationship with the furnace manufacturers as a very long-term one? In other words, do you seek for them to grow with you, or as you scale up, a symbiotic relationship? And are you looking for alternate suppliers to make your own supply chain more resilient? And in respect to the furnace manufacturers, the answer to that question is unequivocal yes. In fact, I think it was Martin, one of the shareholders, asked me why don't we get on with just building cell 3? Now, you know, we've got enough demand for it, so we're not. And I made the point that actually it's not cash or even demand that's constraining the need to go on and build cell 3, 4, and 5. It's actually the capacity of our furnace manufacturers, and you know, that problem is not going to go away. So we see the furnace manufacturers as key partners, and the conversations we're having with them are not just about, you know, the next 6 months, 9 months, 18 months. It's about the next 5, 6, 7 years. And so we are having extensive discussions with them, and we're talking to them about all sorts of things, you know, just long-term sequential relationships. Should we have bigger furnaces? There's a very, very deep conversation going on at the moment, and it's exactly the conversation you would expect to have with partners. Question from Tim Grattan, and I'm going to give this to you again, Kevin. It's about competitive intelligence network. Picked up any activity from any other emerging or establishing competitors beginning to look at developing their own carbon ceramic brake products? You know, what about the competition? Where is the competition coming from? I know Matthew covered this a little bit earlier on, but just say a little bit about that.
I'll answer that in two parts, actually. The first part is, look, we do spend a bit of time monitoring what customer comments are on activity with competitors and our own efforts on understanding competitors as well. Look, there's nothing new that's emerged in terms of a new competitor. I'm aware of there's activities in China which are relatively opaque, but the work we've done to understand that says that they're not credible as yet. And even if they were, and even if something emerged that was new for us, I always make the point that there is a cycle to the introduction of a new supplier with their own product, and that's typically sort of 7 to 10 years, just as we've experienced with the introduction of our product into OEs. Part of that process of adoption by OEs is to de-risk the supply and the product. So everybody has to go through that incubation period of advanced engineering before it gets adopted. So I'm not aware of anything in the wider world today, and even if there is something new, it would take that period of a cycle of sort of a decade for that to come through. So we have that as a barrier to entry. The second part I would add is we do have a competitor, this monopolistic supplier, and in terms of technology, we are aware that they are developing a product that, if you like, mimics and copies ours. So in one regard, that's quite a compliment, that they are effectively recognizing that our technology is superior. But it's a fact of life that I think in a marketplace with a mainstream competitor like we have, that they will always be innovating and trying to address some of their weaknesses, if you like, in terms of product in any shape and form they can. And we see that they will probably adopt some of our technologies in the fullness of time.
Yeah, the only thing I'd add to that is that if the competitors were out there, I'm sure the customers would be quick to tell us, because they believe it keeps us on our toes.
Yeah.
So there's a question actually from Mark Dean about, you mentioned today the potential in the medium term to reach capacity at Knowsley. What's your contingency plans, further site in Knowsley or abroad? As it happens, we've mentioned a few times the potential to reach, it was part of the fundraising. We said we thought we'd fill Knowsley in that sort of 24, 25, 26 period. Not sure precisely when. And in terms of contingency plans, we are obviously, we can't say we're not talking about it. Of course, we're talking about it. But frankly, the prime need at the moment is to deal with the here and now. We will only have this delightful problem of what we do after we filled Knowsley, once we've, if we perform. And so all our focuses and all our efforts are actually on performing, on making sure that there isn't an execution risk, or minimizing the execution risk is probably the best way to say it. So that's the central issue, and we don't have the plan, but I can't pretend we're not talking about it. Let's see another question here about, there's a question here about, are you an ESG investment? Kevin, do you want to say a few words about that?
Yeah. Like, let me start. The simple answer to that is yes, I think we are, and that's principally led from our product offering point of view. Our product, as I've already mentioned, has extended life, so it eliminates the need for replacement iron parts through the lifetime of the car. So we're eliminating effectively an environmental impact of replacement parts. That doesn't just apply to the brake disc; it applies to the brake pad. We reduce the wear of the pad by about 50%. So, and as I've said, that it impacts on the environment from a pollution point of view, but also impacts on replacement pads as well. So again, the pads last significantly longer with a ceramic brake. Then, of course, the product goes on to have lightweight features. So whether it's for a combustion engine, it reduces the CO2 emissions, or the range on electric vehicles. And not least, our product is made of carbon, and our processes actually are effectively a carbon capture technology. And we effectively make a carbon sink with our brake, which lasts the lifetime of the car, and then will retain the carbon for life, basically, and capture it and lock it in. So I think we are pretty good in terms of our product. In terms of other things on ESG, about the social side and the governance side, we do work to the QCA Code of Conduct for our governance, and we do have aspirations to be more involved in the region. We've taken on some apprenticeships last year as part of our work with the local authority, and obviously our recruitment drive that we're going through in the creation of jobs is important in what is underdeveloped area of the country, as Knowsley is. But there's more to do, and the one thing I would say is, if I look internally at our processes and production side of things, we've got lots that we can improve upon there. And so we see ESG not only as fitting with our product offering, but in the fullness of time, we think our processes will be very environmental friendly, but there's work to be done to optimize them. And the driver for that isn't just ESG, I might add. It's, there is productivity and cost savings to be had by doing all of this stuff for ESG, and that's something we're very focused on.
Yeah, I'm old enough to remember when quality first came from the Japanese back in the 70s, and it was a lot to talk about quality, and everyone sort of missed the point that it was actually the biggest driver of productivity than anything else I'd ever seen. And this drive to Six Sigma, and I think ESG is the same. Yeah. Julian, I know you feel strongly on this subject because we've talked about it at some length at the board. Do you have anything to add to that as to how you see us as an ESG investment?
No, I think Kevin summarised it very well from my initial perception, David. I think from the point of view of the social and governance aspects, I think the team is working in the right direction. And we have to, continue to be on our mettle there and looking for further opportunities. As Kevin said, there's been a lot of work done, for example, with the apprentices, etc. More work that can be done. And we have to ensure as we grow that our governance is very robust. And of course, that any sourcing that we do is ethical sourcing, and that we fully understand the value chains. And I know that the team has been doing work on that, and that will become increasingly important, because it's always an area where organizations can be vulnerable to knowing, the full detail of the value chains of what they buy in, the products and services, etc. So I think that's what we can continue to do. And as Kevin said, I think the internal processes will be the next big area of focus and opportunity. So I think it's challenging for all companies at the moment, large and small, to to really get their arms around the right actions around ESG, so that we put real kind of meat on the bones and don't just talk about it. And I think from what I've seen, Surface Transforms certainly has a very strong intention to do the right things here, and has been doing the right things. And I think with our renewed and increased focus on that, we will grow and become a strong player in the area of ESG. That's, I think, the intention of the board and the executives.
Okay, thank you for that. I'm going to have a complete change of subject now. It's a question, I'm going to give this one to Michael. It's from Philip T about inventory levels and supply shortages. There's been a lot in the papers, although in fairness, I think it's mostly been about electronics actually. There has been a lot in the papers about inventory levels and supply shortages being topical during the pandemic. What Surface's approach to this? Are we increasing our inventories? Are the OEMs asking us to increase the inventories? I mean, what's going on?
So our contracts pretty much all require us to hold some level of buffer stock anyway. So we already have in our plan holding approximately a month, and where a customer hasn't requested it, we've still factored it in, given where we are in our own development. It's prudent to be in that position. As far as supply chain goes, though, we really haven't been seeing any issues actually with the products that we're after. We're very lucky that our main fiber product is we have dual sourced, so we can get that from 2 different locations, both UK and Europe. So we haven't seen any issues there. We've seen those supplies coming in despite Brexit and everything else, and the slight hiccups in supply chain there. That's all working quite well. But as far as our customers are saying, I think that's actually probably the semiconductor issue that is affecting the automotive sector is actually probably giving more grist to the mill of us being selected, actually, because they've seen the issue of having single source supply for their semiconductors, and a lot of them don't want to fall into that trap with ceramic brakes either. So it's quite I think it's a positive actually in some ways, the supply chain for us.
Let's move on to the cost reduction program. Martin Oems has said OEM Cell 1 meeting SOP marks the end of the 5-year unit cost reduction plan, which I think halved the cost. Actually, I don't think it has halved the cost. Can you tell us about the next 5 years cost reduction plan, the possible targets broadly? And do you want to say a few words on the efficiencies recently derived and announced in the small volume production cell?
Let me start by saying we set out that 5-year plan for cost reduction and have delivered against that really well. So it's something the team have done fantastically well, and it's a job well done. So I have to give the guys really a heap of credit for what they've achieved, because it looked, I think a lot of people at the time when we said we were going to halve the cost wondered how that would be done. Now to move on from there, it's a continuous never-ending job, cost reduction, particularly for automotive businesses. So what do we want to achieve again? I'd love to, I haven't got a 5-year plan to lay out for everyone today, but frankly, I'd be disappointed if over the next 5 years we weren't looking at something similar, where we were trying to do a half-life of costs again. That's not to say that that's our plan right now. That isn't, but I do know that we have a host of projects which we believe will significantly reduce our costs, which are productivity and process improvements and are not linked to scale per se. So this isn't just to do with reducing costs by volume. We believe there's significant opportunity to reduce those. But I think, and I've alluded to this in the past, the cost of the product shouldn't be just focused on in terms of process. It should be focused on in terms of its size. And this is an industry where size matters. Most of the vehicles we are on today are very high performance, high demanding requirements for brakes, which means they are extremely large. And the volume that the disc occupies, so that's all using all 3 dimensions, is critically important to the cost to manufacture, and it is the biggest link. So if I want to try and reduce the cost of our product in the future, one of the easiest ways we can do it is by shrinking the size, and that's one of the advantages of our technology in terms of size equals to how temperature, and we run cooler. So it's something we are focused on, not just from a cost reduction of process, but are focused on in terms of application engineering as well. And we believe there's opportunities on application engineering to reduce the cost as well. So we're very confident for the future in terms of our cost reduction plans.
Yeah, it's fair to say, isn't it, Kevin, that we've been educating the customers on the criticality of size, stroke volume, and the price curve. And the phrase which I love using is they are designing the wheel sizes to the constraints of our competitors' products. That we free them from. And there's been quite a number of very interesting discussions in that regard.
Very much so.
On the sort of broad thing, I'll give this one to Michael about admin expenses. How do you expect, from Malcolm Hay, how do you expect administrative expenses to progress over the next few years as you ramp up volumes?
As everybody's aware, we're a capital intensive business, and that will always be where the vast bulk of our expenditure goes on that. As far as the administrative expenses, we're in that phase now where we're obviously growing, and we will always, I think, outrun our current position going forward. So as we're growing, we will definitely be bringing on people before we have the revenue to back that up. Now, I think as we announce new contracts and build new sales, we'll run ahead potentially with our team as we're trying to get those sales installed. So I see administrative expenses going up. That said, it won't be a huge part of the business. We will always, I think, currently looking at our projections, I said this in the presentation, we still see our net profit at somewhere around the 20 to 25% level. So our administrative expenses, whilst increasing, will never be get to a level where they will severely impact our bottom line, we don't believe.
A couple of questions here from John Gilbert, and I'll take the first one. It said, are there any plans for staff owning shares? It's easy to answer because everybody in Surface Transforms, after I think, is it 6 months, employment gets share options. And we have exactly what you'd expect to have. Everybody gets a number of share options, and then clearly there are the number of share options you get bigger the more senior you become. So we are, everyone is, after 6 months, is a shareholder in the company. And I can tell you, they take it very seriously. And I'm actually quite pleased that a few of them have exercised their options recently and made some useful amounts of money for the sort of against their base salary. They might have, I think they should have hung on to the shares, but that's it's not for me to say what people do with their money. But that is important to us, the fact that we are a share owning company. Everyone is a shareholder in the company. And another one from John here is what happens? Can you take this, Kevin? It's sort of related to ESG actually. What happens at the end of the break at the life? What is the end of recycling, circular economy?
Very simple for a restaurant break. It ends up in landfill. Now I know people then ask me, can it be recycled or reused as part of sort of ESG thinking? And the simple answer is, it's a safety critical part for a car. So, and it's been designed to work on a particular platform of car. So the idea of them taking that disc and not putting it into landfill because the car's reached end of life and trying to reuse it on another car isn't going to be possible today because of the safety critical nature of the brake. You would want to go through a huge amount of testing and redesign, if you like, to ensure that could be put on something else. So I think the simple answer is it's a carbon sink. It locks in that carbon and then it goes to landfill. Whether that changes in the future, I don't know, but because of the safety critical nature of it, I wouldn't expect it to change.
But there is a question here, Kevin, which I'll throw at you because we get asked this all the time, actually. Does the material have potential use in other areas, and is there a scope for licensing the technology? And
well, can I answer that with a yes? Yes, it does, but no, we won't, because as you've probably gathered, we've got some fantastic opportunities and challenges ahead of us, which mean we're incredibly focused on what we're doing. To allow ourselves to be distracted and being given other things to look at would be the wrong thing to do for this company right now.
Actually finish on a more positive one, and it sort of goes back to the question before about the price curve and volumes. It's from James. Are you working on next generation products, and will these eventually be applicable to medium and small size cars?
Are we working on next generation products? Yes. Will they be applicable to medium, small cars? Don't know. Is the simple answer to that. I'd like to remind everyone, we talk about our addressable market being a £2 billion market. If you start talking about the small, medium-sized cars, that addressable market is multiplies up significantly. But again, coming back to focus, I'd be very happy winning a large chunk of that £2 billion market first of all, and then worrying about the medium, small cars later.
Yeah, we've said that a few times to people ask us, let's get to 2 billion before we start talking about it.
Yeah,
all good things must come to an end. So I'm going to thank all the shareholders for attending. I want to thank my colleagues on the board for their contribution, and I particularly thank our friends at Hardman Co for hosting the webinar today. And with that, I'm going to close the recording, and thank you all very much, and we'll see you all again in due course. Thank you.